Let's dive in. SoFi Technologies just made headlines with a massive stock surge. After months of stagnation and skepticism, the stock suddenly rocketed, catching everyone's attention. This wasn't a minor uptick, it was a double-digit leap that validated patient investors and made doubters rethink. So what changed? SoFi's latest announcement shifted the entire narrative. This isn't just about a price jump, it's about the market finally recognizing SoFi's potential as a digital financial powerhouse. SoFi isn't your typical bank. It's a one-stop digital platform for loans, investing, banking and more, all on your phone. The success of this model could reshape the entire banking industry. But before you get swept up in the hype, let's break down what's really driving this surge. Is this the start of something sustainable or just a flash in the pan? We'll dig into the numbers, expert takes, and risks so you can make an informed decision. Let's get started. What triggered SoFi's explosive move? It was a perfect storm of three factors in their latest quarterly update. First, SoFi finally posted a profitable quarter, ending years of doubt about its business model. Second, management didn't just celebrate, they raised their outlook, signaling confidence in continued growth. Third, SoFi highlighted the strength of its tech platform Galileo, showing it's not just a consumer bank, but a key player in fintech infrastructure. This trifecta, profitability, bullish guidance and strategic growth, created a narrative Wall Street couldn't ignore. Each factor reinforced the others, addressing fears and fueling optimism. The result? A surge that changed how investors view SoFi's future. It wasn't luck, it was a clear signal the company is turning a corner. Let's break down the numbers behind this shift. The numbers tell the story. SoFi reported its first ever GAAP net income, a milestone that proves the business model works. While the profit was modest, its significance is huge. SoFi is now generating, not burning cash. Revenue soared, beating analyst expectations and showing strong demand across lending, financial services, and tech. Member growth was impressive, with millions joining, each new member a chance to cross-sell more products. This financial services loop means more products per customer, driving higher revenue and profit per user. Deposit growth was another highlight, billions in new deposits, lowering SoFi's funding costs and boosting resilience. With a bank charter, SoFi can fund loans more cheaply, giving it a major edge. These results show a foundation that's not just growing but strengthening. Profitability, revenue, member growth, and deposits, all moving in the right direction. The market finally took notice. But SoFi's ambition goes beyond just being a bank. Here's what makes their model unique. SoFi isn't just a bank, it's aiming to be your financial gym. Traditional banks are transactional. SoFi wants to be a membership, offering everything from loans to investing to credit cards. The goal? Get you in with one product, then keep you engaged with more. This flywheel effect means the more you use, the more valuable you become to SoFi, and the harder it is to leave. More members mean more data, better products, and faster growth. With digital efficiency and a bank charter, SoFi can offer better rates and innovate quickly. The company's now at escape velocity, past the hard part, accelerating on its own momentum. That's why the market is suddenly excited. SoFi's model is working, and the growth cycle is spinning faster, but what do the experts think? Let's see how Wall Street is reacting. Wall Street is taking notice. After the earnings report, analysts upgraded SoFi, raising price targets and shifting from cautious to bullish. The bulls love the growth, profitability, and the moat created by SoFi's bank charter. They see the expanding financial services segment as the key to long-term success. Some even predict SoFi could become a top 10 US financial institution. But not everyone's convinced. Skeptics point to SoFi's reliance on lending and thin profit margins. They warn that an economic downturn could hit SoFi hard. Others are waiting for more consistent results before fully buying in. The consensus is turning positive, but debate remains. Let's talk about the risks you can't ignore. Time for a reality check. SoFi's path isn't risk-free. The biggest risk-heavy exposure to lending. If the economy sours, loan defaults could spike, hurting profits. Competition is fierce, from fintech giants and traditional banks alike, all fighting for the same customers. SoFi must keep innovating and spending to stay ahead, which could pressure margins. Regulation is another wildcard. New rules could impact fees, costs, or even the business model. And while SoFi is now profitable, the margin is slim. A few bad quarters could reverse that. Growth companies are volatile by nature. Expect bumps along the way. Investors need to be comfortable with uncertainty and potential swings. The upside is big, but so are the risks. So, what does this all mean for your portfolio? Let's put it in perspective. What does SoFi's surge mean for you? For current investors, it's validation. The thesis is playing out, and the market is rewarding it. For those on the sidelines, the risk profile has shifted. SoFi is now a proven, profitable player, not just a speculative bet. The key question: how big can SoFi get from here? The company has crossed a major threshold, proving its model can scale and make money. Now it's about growth. Can they keep adding members and cross-selling products? The narrative has improved, but future gains depend on execution. Every investor must decide, is this just the beginning, or is the surge already priced in? Your answer shapes your next move. Let's talk strategy. So, what should you do? If you're a long-term believer, holding makes sense. The thesis is working, and more upside could be ahead. Consider trimming some profits if you want, but don't feel pressured to sell everything. Thinking of buying? Don't chase blindly. Start small, use dollar-cost averaging, and build your position over time. Waiting is also valid. After a big run, stocks often pull back or consolidate. Patience can pay off if you're worried about buying at a peak. Ultimately, your decision depends on your risk tolerance, timeline, and financial goals. There's no one-size-fits-all answer. Young investors might take more risk. Those near retirement may want to protect capital. Do your research, know what you own, and stick to your plan, even if volatility returns. The most important thing, make a decision you can live with. Now let's wrap up. That's the full story behind SoFi's surge. It's not hype. Profitability, strong guidance, and a working flywheel model are driving real change. SoFi's ambition is huge, but so are the risks. Lending exposure, fierce competition, and regulatory uncertainty. This is a high-growth, high-risk play, not a get-rich-quick scheme. So what's your take? Is SoFi just getting started, or is this as good as it gets? Let me know in the comments. Are you holding, buying, or staying on the sidelines? Thanks for watching. See you next time.